I'm about to teach you everything there is to know about ICT. When I first started, I was overwhelmed by all the complicated concepts, but once I simplified it into the 3 steps I'll teach you in this beginner's guide, everything changed. Fast forward to now, and I just broke the world record for the largest prop firm payout in history at $2.5 million. And today, I'm going to show you the exact strategy I used to do it. First, let's talk about market structure. Now, everything else in ICT revolves around this, and it's the foundation of everything. So first of all, what is market structure? Market structure is built from how price forms its swing highs and swing lows, the turning points that reveal who has control of the market. A swing high forms when a candle has at least one lower high on both sides, signaling a temporary ceiling, and a swing low forms when a candle has at least one higher low on both sides, showing a temporary floor. Now over here we have some crude depictions of what market structure actually looks like. So as you guys can see, as the market is trending higher, we have a low, high, higher low, higher high, higher low, higher high. And over here we have a bearish market structure where we have a high, low, lower high, lower low, lower high, lower low. Now, why is this so important? Well, market structure is the backbone of price action. It shows you how the market is moving, who's in control, and where high probability opportunities form. By understanding the sequence of highs and lows, you can quickly identify trends, ranges, reversals, and liquidity targets. Now, this keeps you from guessing and helps you trade with clarity instead of emotion. And in simple terms, market structure tells you where price is likely to go next and helps you avoid getting caught on the wrong side of the move. Now, I emphasize likely because we're just trying to make a prediction. At the end of the day, nobody really understands where the market is going to go next, and we're just trying to make an educated guess on where it might go. So if the market is consistently making higher lows and higher highs, we can anticipate that the market is going to continue in a bullish trend until that market structure is broken. And vice versa, if the market is making lower lows and lower highs, we can anticipate that the market is going to stay in a bearish trend until one of those swing highs is broken. So again, likely does not mean that this is a guarantee. We're just trying to make an informed decision and spot high probability opportunities in the market. So if the market is continuously making higher lows and higher highs, there is a high probability that the market will continue to make higher lows and higher highs. So how do we identify market structure? And here's a step-by-step guide. So first of all, what is a swing high and what is a swing low? So over here, I've drawn out some crude depictions of what a swing high is. So here you can see that this candle here has a high, and then we get a higher high on the following candle, and then a lower high. So this 3 candle pattern is giving us a swing high because we have a high, and then we have lower highs on either side of that candle. Now the inverse example is a swing low. You guys can see here that we have a low, a lower low, and then a higher low. So we have higher lows on either side of this candle, and this is our swing low. So first we're going to scan from left to right and label each confirmed swing high and swing low. Again, the swing high is defined as the highest candle with 2 lower highs on either side. And a swing low is the lowest candle flanked by 2 higher lows on each side. So if we have 2 candles here that have closed and this 3rd candle is still trading, it is not quite yet a confirmed swing high because we don't know by the end of this candle, we might come up here and print a higher high. So until this 3rd candle closes, it is not a confirmed swing point. Now, pro tip, when your analysis leads you to believe that the market will move in one direction, you want to steer clear of structure shifts that indicate the opposite direction. So for example, if you anticipate a bearish market, say on a higher time frame, and have targets set below the current price, any bullish market structure shift is likely to be a false signal or a liquidity grab before the market continues to decline. Again, the goal of this is to remain aligned with the higher time frame market structure to find asymmetrical risk-reward opportunities. If you are continuously trying to counter-trend trade against the higher time frame, you will be missing out on the higher risk-reward opportunities. Now, here's just a quick chart example of market structure at play. You guys can see here that we have a low, a high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, right? And inside of these price swings, we do have more short-term swing points, right? You guys can see here that we have a swing high here, a swing high here, and then we eventually have this swing high here. And this is what I mean by staying on side with the higher time frame order flow. Now, if you always use a higher time frame that supersedes the lower time frame, maybe if you look on a weekly or a monthly chart, that we might not actually see these swing points in here. Okay, these might be daily swings, but overall, maybe we haven't created a new weekly or monthly high. And overall, the market on a weekly or a monthly time frame is only creating lower highs. Now, I want you guys to spend some time analyzing this chart because you guys can see that every time we run out a short-term high, it is very short-lived. And again, the asymmetrical risk to reward opportunities are going to be bearish. So even though we might see some counter trend trades in here where the market is slowly pushing higher and taking out these swing highs, if you try to position yourself long above these swing highs as a market structure shift, you guys can see that they eventually fail because the overall high time frame market structure is still pointing lower. And instead of trying to catch these small, 2-3 days of upside, you're trying to position yourself short after running out those short-term highs because the overall market structure is still going lower. Now, again, the better risk to reward opportunities are going to be short following this trend lower. So just remember that market structure is just useful as a guide to help us make informed decisions. That doesn't mean that we're always going to perfectly predict when the next major swing high is going to form. And we're really just trying to get on side and in sync with the higher time frame trend. All right, so now that you understand market structure, you might be wondering how to find the best places to trade. And that brings us to the next piece of the puzzle. Now, this is where the magic happens. Key levels are the footprints left in the market that show us where we want to do business. Now, think of it like this. Market structure gives us the destination or the most probable destination, and key levels give us the turn-by-turn directions. They're the structural points where institutional money has left its mark, where liquidity sits waiting, and where price is most likely to react. Now, these aren't just random lines on a chart. They're the exact levels where smart money has operated before and will likely operate again. Now, how to identify our key levels? Now, first of all, we have external levels. Now, what do I mean by that? It's mostly the highs and lows of a specific range of data. So we might have previous monthly highs and lows, we might have previous weekly highs and lows, previous daily highs and lows, and previous session highs and lows. Now, in here, this is a monthly time frame, so you can see me mark out the monthly high and the monthly low in here. But inside of this monthly range, we have smaller data points that we need to pay attention to, okay? Previous daily highs and lows. So inside of this monthly range, we're going to have swing lows, swing highs, right? Another swing high in here, another swing high in here, a swing low in here. So when I sit down in front of my charts, I make sure I plot out my previous monthly highs and lows, previous weekly highs and lows, my previous daily highs and lows. And if you're an intraday trader, you want to mark out your previous session highs and lows. Now you have your Asian session, which is 8 p.m. Eastern to 12 a.m. midnight. You have London session, which is 2 a.m. Eastern up to 5 a.m. And then New York session, about 8 a.m. to noon. And if you trade index markets, you might only want to have 9:30 to noon. So along with external levels, we have internal levels. And the one that I use the most and the one that's most easily spotted on the charts are fair value gaps. So what is a fair value gap? It's a 3-candle pattern where price moves so fast that it leaves a gap between the high and low of candle 1 and the high or low of candle 3. So you guys can see here on this chart, we have candle 1, right? Candle 2, and then candle 3. And you guys can see the high of candle 1 and the low of candle 3, there's a gap there. So between candles 1 and 3, this wick of candle 3 never comes back down to retest the high of candle 1. And this leaves a fair value gap. So inside of the body of this candle is a gap where if price retraces to that level, it might pick up all those resting buy orders and then turn around. Okay, so the market likes to return to these levels prior to trend continuation. So for me, fair value gaps are one of the most easily identifiable and important internal levels that I can see on a chart. And for a beginner like you, one of the easiest setups to trade. Now, how do I use key levels to frame my trades? Well, previous highs and lows and fair value gaps can be utilized for both stop losses and or targets. So as an example, you might want to long the first presented fair value gap intraday with a stop below the previous day or previous session low. And then all you're going to do is target a previous day or session high or a bearish fair value gap that's above the current market price. Now, this trade example and this process is based on sound logic. You have a trade idea, You have an invalidation, which is your stop loss, which should go below a previous low. And then you have your reward or target, which is also a previous higher low. And then your entry is internal range liquidity using a fair value gap. Now, before we dive into trade execution, I want to give you guys something that will make this even easier. I put together a free black book of entry models that you can download. It has all of this in a PDF format, so you can refer back to it when you trade. I'll leave that link in the description. Now, for the final piece of the puzzle, let's talk about how to execute your trades with precision. Let's talk about my model, and I want to keep this as simple as possible. First of all, you're going to identify market structure and key levels. So again, just remember that we're looking for swing points, so swing highs and swing lows. Then we have previous days highs and lows, previous weekly highs and lows, previous monthly highs and lows, or previous session highs and lows. Now, based on the above, we want to determine our directional bias. So if we're bearish on a market, we do anticipate that the market is going to create lower highs and lower lows. So if we put our stop loss above a swing high, it should not be taken out. And even if it does get taken out, maybe that's just a short-term rate on liquidity, in which case you might want to try and find another entry as we resume the trend lower. So just remember that just because you got stopped out on one trade idea does not mean that overall your trade idea is wrong. It could just be a short-term sweep on a high before the market continues lower. Now, step 3, we want to wait for a fair value gap that aligns with our directional bias. An example, if our bias is bearish, we are only looking for bearish fair value gaps, and we want to avoid any bullish setups. So if I'm bearish on a high time frame, I'll essentially avoid all bullish setups, because what happens is you try and take that lower time frame bullish setup and it ends up failing. And let's say, for example, you're a trader that has a 30% win rate. Well, an easy way to increase that win rate is not by adding things to your system and your strategy, it's by filtering out more losers. So if 70% of your trades are losers, you can increase the profitability of your system by filtering out as many of those losers as possible. Maybe 20% of those losers you're going against the high time frame bias, or maybe you're making mistakes like over trading or revenge trading or over leveraging or just trading outside of your rules. If you find a way to remove that subset of poor trades, you will become more profitable. Now, step 4, we're going to enter on a retracement into a fair value gap with a logical stop above a swing high if bearish and below a swing low if bullish. And we're going to target an opposing key level. So we're going to target previous lows if bearish, and we're going to target previous highs if bullish. And step 5, we're going to manage the trade as needed. Maybe you want to take partials, maybe you want to adjust your stop. Just know that if you adjust your stop too aggressively, the market might kick you out before it goes in its intended direction. Or you might not want to manage the trade at all, because if you micromanage all of your trades, you'll find that it hurts your profitability. So you might want to just set and forget your trades. And that requires you to wait patiently for the outcome. Now let's go over a couple different executions. So let's say we sit down in front of our charts on Friday at the close and we determine that we're still bearish based on the high time frame. And as I mentioned, when it comes to market structure, any rate above a short-term high may just be a fake out. Okay, so if our high time frame is leading us to believe that the market is still bearish, we would not look at this closure on Monday above the swing high as a market structure shift. All right, this is just a fake out. So when we get the closure back below the previous daily high, and then we get this fair value gap here, we have 2 different fair value gaps that we can actually execute on. So let's say if we entered on either one of these fair value gaps, we actually want to use this old swing high back here, right? If we just look at all this price action here, we don't have a swing high in any of these candles. So after we run out this high, right, where is our swing high? None of these are swing highs because it requires a lower high on either side of the candle. So this is a swing high. You guys can see, if you really zoom in on this candle, we have a swing high here because we have a lower high on either side of that candle. And then our next swing high is not until we print this one here. So we have this this high, then we have a higher high, and then a lower high. Now, if you entered on this fair value gap, your stop loss would probably want to go above here. But if you entered on this fair value gap, and then we get this swing high, you might want to put your stop loss above this swing high. Okay, this one is actually a tighter risk reward. And then we're just going to target what? A previous session or previous day's low. So in this scenario, we're just targeting Friday's low. Now, again, once you enter the trade, though, we don't know how this market is going to trade to get down there. So here it took a little over 12 hours to get to its target. But again, once you enter the trade, we don't know if this market could go sideways on us. And this market could have gone sideways for multiple days before hitting the target. But your trade, when you frame a trade, is based on what you're seeing in the market in that specific moment. So in this specific moment, everything is aligned. We have our high time frame bias based on market structure. We have a fair value gap that we're entering in on, and profitability long term is just based on how you frame your trades. So if you can continuously frame trades with asymmetrical risk to reward, where you have the stop loss as your invalidation and a target, and as long as your target is greater than your stop loss, over time you should make money. No matter if your win rate is 40%, 50%, or maybe even less. Maybe your win rate is only 30%. If your risk to reward is high enough, overall you should be a profitable trader. But where a lot of traders mess up is they don't have the patience to be able to sit in these markets as they're going up and down and up and down and up and down, and have the courage to just kind of sit still. So even if this market trades a little bit higher, let's say if it dug into this fair value gap one more time, but it never stops you out, and then it rolls over. Well, every trader that would have exited because they were fearful of losing money, let's say the market traded a little higher, right? After you entered into this fair value gap, maybe retested this previous daily high again, and then it rolled over. Okay, this is really where a lot of traders mess up and close their trades prematurely, because they haven't accepted the fact that once they put the risk on, the risk should be on. Okay, once you put your risk on, you should already accept the fact that you might lose on the trade. And if you can't do that consistently over time, you will find that you'll be exiting your trades too early. You'll be micromanaging your trades. So even if it goes in your favor a little bit, you might jam the stop, and then you get stopped out at break even before it runs in your favor. Trade management is very finicky. And a lot of times when you're micromanaging your trades and you're over managing them, it hurts you more than helps you. Now, here's a bullish example, right? Let's say we come to our charts Monday afternoon and we determine that we want to be bullish the following day. Then we're looking for a fair value gap to enter long. So as this market's trading down into the fair value gap, you could have entered anywhere in here, right? Let's say you entered anywhere in here and your stop loss goes below the previous daily low. Well, even if you entered here and the market traded against you right away, the fact that it doesn't take you out of the trade, right? This is your invalidation. Your stop loss, you pay the stop loss to do a job. Okay, the trade is not invalidated until it hits your stop loss. And if it does hit your stop loss, you should be comfortable with the amount that you've put on and be comfortable with that amount of loss. And what we're going to do is either target a session high. So you could have either targeted this Asian range high, or you could have targeted this previous daily high. So let's talk about some common mistakes that most traders make. Now, mistake number one is obviously trading against the high time frame trend. I can't emphasize this enough. I was one of those traders that would have a higher time frame bias, and then I would find myself on the low time frame trading against that high time frame bias because I thought the trend was changing. And I would maybe, let's say if I was bullish on the higher time frame and I'd see bearish setups appear on the lower time frame. Well, instead of me just sticking with the higher time frame, I would get manipulated into the market and I would take that short position. So if a bearish setup showed up and I didn't want to be bearish, I took it anyway. And then the market would just kind of just turn around and then stop me out. And instead of me just staying on side with the higher time frame, not only was I taking a loss, but I was missing out on the move that I was looking for. So I was going short here when I really should have just been going long. So not only was I getting stopped out, but I missed out on the profits of being long in the first place. Okay, so when you review your journal, you have to pay attention to these things because it will be very frustrating. I know many of you guys will probably watch this video and say to yourself, you know, I do this too often. Now, mistake number two, abandoning the strategy after sustaining a few losses. Again, I was the type of trader that would watch a video like this, have a simple strategy, something that is repeatable and doesn't have a lot of moving parts. And what would happen was I would go on a winning streak followed by a losing streak. And after the losing streak, maybe I had 5 or 6 losses in a row, I would abandon the strategy. Okay. And the whole point of this is that you need a very large sample size to determine if a strategy is profitable enough. Okay, don't just watch this video, take 10 trades, and then just come to the conclusion that this is not profitable. You have to trade the strategy long enough through multiple market conditions to understand if it's going to be profitable enough. Now, mistake number 3 is micromanaging trade ideas that eventually pan out. And for me, I would micromanage by taking positions in the opposite direction, moving my stop losses too aggressively, scaling in too aggressively. I was just doing too much. Whereas if I just slowed everything down and slowed down the amount of decisions that I had to make and made less decisions and took less actions when it came to my trading, my trading actually got much, much better. So instead of micromanaging your trade and you're placing your trade, now all of a sudden you're watching it incessantly, right? You place the trade, now all of a sudden you can't get your eyes off the screen. And if you're a swing trader, this probably resonates with you a lot more because maybe you're holding trades overnight and you can't put your phone down, right? You're constantly looking at the markets. And I argue, even for intraday traders, that they don't need to sit in front of the charts and watch their trade pan out all day long. Because I think micromanaging your trades is a very unhealthy way to trade markets. Now let's talk about consistency over time. Again, a profitable strategy doesn't need to have an extraordinarily high win rate. With the right risk management, a good strategy can sustain 7 to 10 or more losing trades in a row and still be profitable long term. This is something that I just didn't understand. And the key to consistency is showing up and repeating the process regardless of the short-term outcomes. Now, I want to go over some of the backtest results from some of my students because I think it's very, very important that you guys see this. Now, this is a very simple strategy. All you're trying to do is determine the bias using market structure and key levels, and then use a fair value gap, okay? Fair value gaps work very, very well. Don't add anything else to this, okay? I told my students specifically trade fair value gaps for a very, very long time. What happens with ICT traders is that they get thrown all these different concepts, all these different things, but they don't even know how to trade a fair value gap properly. So what I did was strip things down and just traded fair value gaps on its own. Okay, traded fair value gaps with context. And what I mean by context is by doing the analysis on market structure, on the higher time frame, and on where you think the market's going to go, and avoid any fair value gaps that appear in the opposing direction. Okay, so if you're bullish, I don't want to see you taking bearish fair value gaps. In these backtested examples, this is exactly what my students did. They only stuck to fair value gaps, and you should not be adding new concepts to your system until you've thoroughly tested them, because each setup is different. It's going to give you different results. It's going to give you different statistics. Now, as you guys can see here, the trade win percent is 64%. So yes, they do lose on trades. Okay, they do lose on trades, and they lose a fair amount of them. Okay, 4 out of 10 trades they're losing. But the key here is the profit factor and the average win to average loss. You guys can see here that they were risking roughly $1,000 on each trade, but their average winner was much higher than that. Their average winner was roughly $3,000. You guys can see here on all these green bars that each one of their winners is much greater than their losers. And this is the most important part with trading. And this is why you can find a way to make a lot of different strategies work if you have proper risk to reward. Because essentially what this means is one of these winners can pay for multiple losers. Okay, so these 2 losses is basically erased by one winner, right? This loss is erased by this one. But not only that, as you're stacking winners, you get more and more of a buffer against your drawdown that allows you to go on losing streaks. And that is the most important part with trading, is that your winners need to pay for your losers. If your winners aren't paying for your losers, let's say if you have 2 losers in a row, but one of your winners is only $500. Let's just assume that one of these green bars, most of his winners are $500. Well, it takes 2 wins to make back 1 loss then, because he's losing on average $1,000. And that makes trading very difficult. It makes it an uphill battle. So as you can see, this is a very nice smooth equity curve. And smooth equity curves is just all about how you're managing drawdowns. Yes, he had an outsized loss here. Maybe he risked a little bit more on a setup that he thought was high probability. But then the next loss, he got right back in sync, took a small loss there, right? And you guys can see that the distribution of winners is much greater than these losers down here. Now, I want you guys to just take a look at some of these stats as we go across some other examples. Now, again, this process doesn't change from trader to trader. I told them the same thing. Find a high time frame bias, trade a fair value gap. Now, I've got a question for you guys. If you have something that's this profitable, why would you need to learn anything else? Why would you need to learn order blocks? Or why would you need to learn breaker blocks? Or why would you need to learn weekly profiles? Right? This is all you need. You need a simple, repeatable strategy that creates a boring trading environment. Now look at this P&L here, $41,000. Now compare that to this P&L, okay, $632,000. But look at the stats. The stats are very, very similar. Trade win percentage, 63%. All right, 64%. Profit factor of 5. Profit factor, 5. Average win to loss, almost a 3. Average win to loss, almost a 3. This is using something as simple as a fair value gap. and nothing else. Okay? Look at the average losses to average winners, right? 23K, 66K. It's just a game of numbers. Okay? When you have a profitable strategy, unless you're really moving markets like that with enough capital, you should not have to worry about changing your strategy up. You just need something that's simple, like finding the high time frame bias and trading a fair value gap. And then filtering out losing trades. Okay, when do I not trade this setup? When do I just sit still? Right? Those are the things that are going to make you more profitable, okay? By turning this win rate from 60% to maybe 70%, because maybe 10% of his losers, let's say out of the 40% of his losers, he broke his rules, or he's trading on days that he shouldn't have been trading. He's forcing setups. Okay, that all of a sudden changes these stats dramatically, right? With these 5 steps, you now have a solid foundation for trading with ICT. Now remember to always start with market structure, then identify your key levels, and finally execute your trades with a clear plan. Let's be 1% better every single day. If you want to take this to the next level and work directly with me, I've opened up a few spots in my Inner Circle program. I'll teach you the lessons I've learned over the last 14 years, help you avoid the mistakes that cost me a decade of profitability, and trade alongside you every single week. I'll leave a link down in the description. If it still works, then spots are open, but if it doesn't, that means slots are closed for the next enrollment. I hope you guys enjoyed the video. Make sure you like and subscribe, and I'll see you in the next one.